everybody. My name is Tarek Kawasa. I'm a tax associate with Community CPA. I'm going to be speaking about the Corporate Transparency Act today. Before doing so, this is our website. Ms. Ying Saw is the CEO and managing partner of our CPA firm. Unfortunately, I don't have the pleasure of seeing her today. I have the pleasure of seeing myself. Sorry, I'm trying to figure out a little bit of technical difficulties here, which should be overcome. Okay. So to start out with, the Corporate Transparency Act, or it will be referred to as CTA. The background to this is probably equally as important as the act itself. Essentially, there's 3.7 million corporations and LLCs that are formed under state law every year, or the laws of an Indian tribe. Most, if not all states, or no states, require that they provide information about the beneficial owners of these entities. You have a registered agent, but very few times we ever see who the actual owners are, percentage-wise, etc. And the background of this, again, is that the theory is that there are malign actors, these are the government's words, not mine, that seek to conceal their ownership of these entities in order to facilitate illicit activity, such as money laundering, financing terrorism, tax fraud, tax evasion, even human and drug trafficking. By conducting these transactions through corporate structures, again, this is done in order to evade detection, and oftentimes these companies are layered. So you have an LLC, which is a subsidiary of a corporation, which is a subsidiary, and they don't know who the actual beneficial owners are. Therefore, the problem here is that this undermines the United States national security. It allows nations or individuals of governments that we consider bad actors to open up corporations and to perhaps obtain or purchase items or conduct other activities that would not otherwise be allowed by law. They also theorize that it hurts U.S. economic prosperity. By allowing these nameless entities to engage in such activities, cheating sometimes, provides an unfair playing field. It gives them an advantage over those that are law-abiding and don't have anything to hide. So that's the problem. The solution is what's been called, or what is called now, the Corporate Transparency Act. This is already passed, and it takes effect January 1st, 2024. In summary, entities that are formed or registered to do business in the United States will either need to, 1, confirm that they qualify for an exemption from the CTA's reporting requirements, or 2, timely submit a beneficial ownership information report to the United States Treasury's Financial Crimes Enforcement Network, FinCEN. And we're going to talk quite a bit about what is this beneficial owner information, who needs to file it, etc. This is going to be collected in a centralized database, and it's going to be accessible to the United States government, departments, agencies, law enforcement, tax authorities, even financial institutions such as banks. In some cases, even foreign law enforcement. There's going to be certain requirements. Like anything else, they'll likely need a warrant. But yeah, there will be a centralized database, which for a lot of us brings into question right away, well, I mean, how often do we hear about databases or websites such as the IRS being hacked? And the threat exists that others would have access to that information. So what we're going to talk about today mostly is going to be who has to file, what information needs to be provided, when does it have to be provided or filed, and what happens if you don't comply. So who has to file? Again, corporations, LLCs, and other similar entities, essentially companies that are created by filing a document with the Secretary of State of a state or a similar office under the law of the state or Indian tribe. Now, it does not include general partnerships, trusts, sole proprietorships. So if you just are filing a 1040 every year, you have a C, you're not an LLC, it doesn't apply to you. It breaks down, and this isn't a huge distinction, but it's worth mentioning, there's foreign and there's domestic. Foreign are LLCs, companies, etc. that are formed under the laws of a foreign country but are registered to do business in the United States. And then there are domestic, like I said, those that are filed with the Secretary of State of a state or an Indian tribe. Well, here comes the fun part. We have exemptions. They have delineated 23 different exemptions in which this will not apply to you. I'm only going to really delve into 2 of them because I think they're worth mentioning, but we'll go over them all here anyways. The first and probably most important one are what are considered large operating companies. So if you have at least 21 or more employees in the United States, if you have at least 5 million or more in gross receipts or sales in the United States, and you have a physical office presence in the United States, then this doesn't apply to you. You do not have to worry about it at all. What's important to keep in mind, however, is that a lot of companies may very well fall into this category of a large operating company at one point in the future. However, when they file, when they first open up, that first reporting of beneficial ownership information will be required because they don't meet that criteria yet. Another one that's important, I suppose, would be an inactive entity. A lot of people may have LLCs or companies that are docile or inactive, but they're still there. They're exempted also, but there are conditions that also need to be met. Has to be in existence on or before January 1, 2020. So if you haven't established that or filed for one yet, it's too late. Cannot be engaged in any kind of active business. It cannot be owned by a foreign person. It cannot have experienced a change in ownership in the preceding 12-month period. It cannot have received funds in an amount greater than $1,000 in the preceding 12 months. And it does not otherwise hold any kind or type of assets, whether in the United States or abroad, including any ownership interest in any corporation, LLC, or other similar entity. So you can see what they're trying to do here. Here are the remaining exemptions on the next couple of slides to come. And again, I wouldn't necessarily see one of these and think it applies to you. Even these exemptions have their own criteria to be met. But we have securities reporter issuer, government authorities, banks, credit unions, money service businesses, investment companies. And in large part, the reason that they're not included is because they are typically, or they are already reporting such information to other government agencies and departments, such as the SEC. Okay, insurance companies, accounting firms is a good one because it may or may not apply to your mom and pop accounting firm. What it actually states for to be considered exempt as an accounting firm is it has to have been registered in accordance with Section 102 of the Sarbanes-Oxley Act. So if you're an accounting firm and you're not registered, then it does not apply to you. So this is going to be filed through FinCEN. And there are 3 types of information that need to be provided if you're considered a reportable company. A reportable company, just to kind of back up and clarify, means you don't fall into any of those exemptions that we just went over. So the 3 issues or the 3 types of information are the company information, the applicant information, and then the beneficial ownership information, which we'll be spending most of the time on. So with regards to the company information, it's pretty straightforward. The full legal name of the company, including any doing business as or trade names that you may have, a complete United States address, not a P.O. box, the state, tribal, or foreign jurisdiction of formation, wherever it was formed, and the Internal Revenue Service identification number, employer identification number, etc. Applicant information. This is where it starts to get a little bit nuanced. So a reporting company, or an LLC that you create, that ends up becoming a reporting company, it's not exempt. If it's created on or after January 1st, 2024, which is a couple months away, then they're required to report its company applicants, meaning the individuals that are filing the reports on behalf of the company. A reporting company created before January 1st is not required to report its company applicants. Should be kept in mind, however, reporting companies are required to report the company applicant. The reporting companies are required to report company applicant must identify at least one or at most two applicants, and they have to be individuals. It can't be another company. So you have to have, at the very least, one identified individual as your applicant, and at most two. So there are two types of company applicants. There's the direct filer. It's an individual who directly files a document that created a reporting company. So the individual that filed with the Secretary of State, he also then is, by assumption, the direct filer, the one that files the information in FinCEN. And then there is a direct or controls the filing action. So an individual primarily responsible for directing or controlling the filing of the creation or the first registration document. This could be your attorney, this could be your accounting firm, what have you. And this is the point I wanted to note out, though, is that the reporting company itself, your company, ultimately is responsible for filing this document. So the applicant is not necessarily going to be held liable or held responsible by FinCEN and the Treasury Department. So if you're required to provide the information of the company's applicant, this is what needs to be disclosed. Full legal name, date of birth, complete current address, and a unique identifying number, an issuing jurisdiction from, an image of one of the following non-expired documents. Copy of your U.S. passport, state driver's license, identification card. If you don't have any of the above, then a non-expired foreign passport. Okay, beneficial ownership information, and this is where it gets a little bit controversial, and which is giving people a lot of apprehension. The beneficial owner is determined by the statute as someone that either owns at least 25% of the company or an individual that exercises substantial control over the company. It's the information about these individuals that is now going to be required to be reported in the FinCEN report. And it's not just one nominal beneficial owner for a company, it's two, it's everyone in the company that meets that category. So we're going to spend some time here getting into what substantial control means. What's been provided so far in the statute is that the individual is a senior officer. So it could be a president, CFO, general counsel, CEO, etc. It also has very kind of catch-all language such as any other officer, regardless of official title, who performs a similar function as these officers. So if you have somebody without a specific title, but he carries on the affairs and performs duties that are similar to what a general counsel or what a CEO would do, then he could be considered someone with substantial control. It's also important to note that for purposes of the CTA, corporate secretary and corporate treasurer are no longer being defined as senior officers. And the reason for that is if you kind of drill into what they do, more often than not, they're engaged in more ministerial functions as opposed to actual control or important decision making of the company. So the second element of substantial control, any individual with the ability to appoint or remove any senior officer or a majority of the board of directors or similar body. 3, individual is an important decision maker. Any individual who directs, determines, or has substantial influence over important decisions made by the company, including decisions regarding the company's business, such as, and gets into the detail here of what kind of authority the person has, the nature, scope, attributes of the business, selection or termination of business lines, ventures, geographic focus, entry into or termination or the fulfillment or non-fulfillment of significant contracts. Also finances, the ability to sale, lease, mortgage, or otherwise transfer principal assets, engaged in major expenditures or investments, compensation schemes, incentive programs, all those are indicators that the person could be someone that exercises substantial authority. And here's the final catch-all phrase. Individual has any other form of substantial control over the company. Any other instrument, contract, arrangement, understanding, relationship, or mechanism used to establish ownership. A handshake. If it's so that that person acts able to exercise substantial authority, regardless of title, he's going to be considered someone that is a beneficial owner for purposes of the CTA. This is the other element, is someone who has 25% ownership interests. Okay, now again, you're required to report on all individuals that meet that criteria, not just one. And then we're looking at the types of ownership interests that are included here. Equity, stock or voting rights, capital or profit interest, convertible instruments, options or privileges. So I want to go over some examples here that are provided in the actual, provided in the business owner's guide to understanding this law. And we'll start off with a very simple example that I think everyone should understand. The first is this example of John, who's the sole owner and president of an LLC. He makes all important decisions for the company. No one else owns anything in the company or owns any significant shares of the company or exercises any substantial control over the company. John is clearly the beneficial owner. He exercises substantial control as the president, and he owns 25% or more of ownership interest. He owns 100%. Okay. Example 2. This is a C corporation. Ownership interests are shares of stock. There are 3 shareholders, A, B, and C. A owns 50%, B owns 40%, C owns 10%. And then we have individual D, who is the president of the corporation but does not own any stock. I'll give you a second to think about it, but again, it's pretty simple based on the definitions we went over already. So D, as the president of the corporation but does not own stock, he's still considered a beneficial owner. A, he owns 50%, which is more than 25, beneficial owner. B, same thing. C, 10%, doesn't apply. Example 3. This is an LLC. A and C are the managers. A owns 50%, B owns 50%, C owns 0. A is a beneficial owner. He owns more than 50%. He also exercises substantial control as a manager. B is a beneficial owner. He owns 50%, more than 25. And C does not have anything, doesn't own any percentage of the company, but he exercises substantial control because he's a manager. And this is the final example. It's a little bit more complicated, but it's also, if you understand the rules by now, it's pretty easy to break down. The reporting company is a C corporation with multiple direct and indirect owners. And here's a flow chart kind of laying it out here for you. Keep in mind, this is the reporting company that we're concentrating on. Disregard these in terms of whether they have to report or not. We're trying to identify who are the beneficial owners of this reporting company here. So we have company Y, which owns 50% of the stock. Company Z owns the other 50%. And then the indirect owners of the reporting company, but the direct owners of companies Y and Z, we have individual A, who's also a CFO, individual B. Individual A of company Z owns 25%, individual C owns 25%, and is CEO and president. And then we have individuals D and E, each own 25%, and we have individual F, directs important questions through board representation. So if we do the math here, and again, we're focused on the reporting company. In this situation, A, he is a beneficial owner. As CFO, he exercises substantial control. In addition, he owns 27.5% of the reporting company. Let me go back there again. A, he has 30% of 50%, 25% of 50%. 30% of 50% is 15%, 25 of 50 is 12.5. So in total, he owns 27.5% of the reportable company and is a beneficial owner in that regard as well. B is a beneficial owner. B indirectly owns 35%, which again, 70% of 50%, right? Puts it at 35%, which is greater than 25. C is also a beneficial owner. As CFO, C exercises substantial control. He indirectly owns 12.5%, which is less than 25%, because he only owns 25% of 50%. We'll go back and take a quick look at C again. Right here, 25% of 50. D and E are not beneficial owners. Indirectly, they each own 12.5%. 25 of 50. F is a beneficial owner. Even though he owns 0% of the reporting company, he exercises or she exercises substantial control by being a member of the reporting company's board of directors, thereby making important decisions. So here are, again, some statutory exemptions to having a report as a beneficial owner. One is if you're a minor child. However, the minor child's parents must file in lieu of the minor child, and that minor child, assuming that they still are defined as a beneficial owner when they reach the age of majority or 18, then they do have to file upon reaching 18. A nominee, intermediary, custodian, or agent, someone who's just acting on behalf of the actual beneficial owners as their nominee, intermediary, custodian, or agent. If you're an employee, and they're replying upon a strict definition of what an employee is here. So if you're an employee of the company, you must be the employee by law, in other words, subject to the will and control of the employer in what and how to do your work, and the employer may discharge that individual or fire him. The individual's substantial control over economic benefits from the reporting company is derived only from their employment status. In other words, they don't have any stock options or own any large percentage of the company or have anything else other than. Also, the employee cannot be a senior officer, does not hold the position or exercises the authority of a president, CFO, general counsel, CEO, COO, or any other officer regardless of title who performs similar functions. Inheritor. If you or someone has a future interest through inheritance such as a will, then you're not currently considered a beneficial owner to report. However, once that interest has been transferred to you, then you do have to report. And I think the last one here is a creditor. Someone that is a creditor of the reporting company, therefore they're entitled to payment from the reporting company to satisfy a loan or debt, so long as this entitlement is the only ownership interest the individual has in the reporting company. So when will this all take effect? Like I said, it's already been passed. It's taking effect on January 1, 2024. When will you have to file? Reporting companies that are created or registered before the end of the year, in other words, if you already have an S Corp, an LLC, a partnership, what have you, you don't have to file this benefit, assuming that you're going to be considered a reporting company, you will not have to file until January 1 of 2025. So they're giving you more than 12 months really to report that information. However, if you create a company or you register after the beginning of the years, then you have 30 days. There has been some discussion and proposal to extend it to 90. From what I was able to verify just within the last couple of days, I don't think that has gone anywhere. I think it's still 30 days. But it's something that we'll keep our eyes on for sure. The other thing to keep in mind here is that if there is a change, any change to the beneficial ownership information, or it was filed and it contained inaccurate information, you have 30 days to file an updated beneficial ownership information report from the time that you became or reasonably should have become aware of the mistake or of the changed information. And I want to talk here a little bit about what could change and what would require you to send or to submit an updated BOI report. If the company's name changes, if the company's address changes from 200 to 201, something as tiny as that will trigger the change. If there's a change in beneficial ownership, if you get a new CEO, if you hire a new manager, if you let somebody else go, that's going to trigger the need to file an updated BOI report. If there are any sales or exchanges of shares or units of the company that affect who owns 25% or more or less, you have to file an updated report. If the identity card used, passport number, driver's license number, if you get a new license and for some reason that identification number changes, you have to file an updated report. Okay. I think I already went over the issue of a minor. If a minor is a beneficial owner, they don't have to file until they reach the age of majority. If a beneficial owner were to pass, then a updated BOI report needs to be filed within 30 days of closing the estate. If a company during the year falls into one of the exempt categories, for example, has 21 employees, 5 million in sales, located in the United States, etc., again, they need to file an updated BOI report to indicate the newly exempt reporting requirements. They have to go on and say, we are now considered a large company. Okay, penalties for failure to timely and properly comply. There are civil penalties, and keep in mind this is per violation of $500 per day. Yes. Now, from the discussions that I've followed and from what I've read, it's safe to say that this is an evolving law. We don't know exactly how it's going to be implemented, how rigorous it's going to be enforced. But I'm going to put forth a scenario here. Let's say you establish a company, you file a Secretary of State on January 2nd of 2025, and within 30 days, you submit your initial report on beneficial ownership information. Let's say you don't get notified that there was a mistake on there until May or June. So they're not going to start tallying up the 500-day penalty from the time they notify you. They're going to go back to when it was filed. Again, that's $500 per day. If you willfully do not comply, then there are criminal procedures, and you could be in prison for up to 10 years, and you could receive a fine of up to $10,000. Again, if you look at who are considered reporting companies, and if you look at who are not, and some of the exemptions that exist, again, from a lot of the discussions I've followed, the opinion is that this is really is going to have a very large impact on small businesses, and mistakes are going to be made. So the mechanics of filing, how will it be filed? There's going to be what's called the BOSS, or the Beneficial Ownership Secure System. It'll be done all online. It's currently not available. It won't be available. You can't file early. It won't be available until after the first of the year. And they will not accept any reports before the first year. And further guidance and instructions regarding the technicalities and how to complete the forms are being updated all the time. And this is the website if you want to follow it. And you can actually subscribe to news updates and should be informed of any new developments. Because there's a lot of hype about this also, FinCEN has actually set out an alert because people are slowly becoming aware of this new Corporate Transparency Act. And they have been informed that there have been fraudulent attempts to get information from individuals that may fall under the reporting requirements. And apparently these emails are titled Important Compliance Notice. So please, if you see anything like that, don't click on it, don't follow it. FinCEN does not send out unsolicited requests for information. Do not respond to any of the messages, do not click any links, or scan any QR codes that might be contained in those emails. Can't emphasize that enough. So again, I'm going to kind of summarize here and then look at a couple other issues and alternatives. But the Corporate Transparency Act is estimated to impact about 32.6 million current businesses, let alone the 3 to 5 million new businesses that file every year. A lot of LLCs are created in the process of estate and asset protection and planning, with structured businesses, real estate investment companies. All these type of LLCs are likely going to fall under the category of a reporting company and will have to comply. If you are the person in your company, there's the applicant. You should also know that this comes with a new fiduciary duty on that person with substantial control. And you have to make sure that duty is owed both to the company and to your partners or fellow owners or shareholders that you comply with the CTA. Some advice, I suppose. Again, this is just for informational purposes, but if you want some time to review this and don't want to report right away, and if you're thinking about opening up a company, I'd say it's probably better to do so before the end of the year, because then you have until January 1st, 25 to file your first BOI report. Again, unless one of those exemptions apply to you. I guess a couple of things of note I wanted to mention. If you look at it from the perspective of the IRS is employing AI technology in trying to determine who potential individuals or companies are that haven't filed taxes. Well, they're going to have access to this database as well, and it's going to provide them probably a very good comprehensive picture of people's individual financial states and income information. The other alternative which is being considered, and again, this is informational purposes only, is that there may be an exemption. I want to say an exemption, but if you look at the words of the statute in the Act itself and the requirement that it be an entity that was required to file with the Secretary of State or a similar position with an Indian tribe, and this is a function of state law, but there are other types of associations that do exist that don't require filing with the Secretary of State, and I believe this is going to be on a state-by-state basis. States, just like corporate law, when it comes to these things, these are decided at the state level. It could be different in Iowa from what it is in Texas, from what it is in California. But what some have proposed as an alternative to this are contract business trusts, which do offer some of the same protections as a limited liability company and are not required to be filed in certain state secretaries of states. They're issued an EIN. But again, this isn't advice. These are just things to consider and to contact Community CPA. We look forward to assisting you with what should be a very interesting year ahead of us dealing with the Corporate Transparency Act. Thank you.